catch up with these big market participants, especially at times like this, find out what they're doing and what they really think about the markets. And like the rest of us, Carl Icahn was watching yesterday's volatility, and today's volatility for that matter, in awe, perhaps fear, stocks moving so much, so fast, and trying to make sense of it all.
I don't remember seeing a market with this kind of volatility in 2 weeks. I can't, and I look back, I've been around a long time, and maybe there has been, and I just forgot about it. But what you're seeing here, I have never seen, so that I can remember.
Wow.
So I do think that this is just telling you something. It's giving you, it's a warning.
Yeah, a warning that given some of the derivative products that are out there, that today's correction could one day, Icahn said, become an earthquake.
Today, you have these triple leveraged ETFs that are crazy. I mean, you have these index funds with leveraged ETFs against them, where I don't see any difference between that and 1929. So eventually, this is just a little rumbling, a little fault line. I think this market will bounce back probably. I think, eventually you get through this little panic thing. But one day, this thing is just going to implode.
So Icahn was on with us, in mid-November, and said that the market had reached, in his words, a euphoric state, that it had, quote, run away, and that a big correction was likely. So this is not probably a big surprise to Carl or many other big investors, especially at Davos, who started saying, you know what, this sounds a little bit euphoric to me. The question is, how long does it last? How deep does it go? No one can answer that question, but Icahn says this is not the big one if you're thinking that it might be.
As I was listening to the interview, I wrote down here in quotes, major storm coming. Those were his words. I don't know whether it's going to be 5 years, 5 months, 5 days from now, but I said, I don't know that, but this is the rumbling before the quake.
So a few years ago, he famously put out his Danger Ahead video. If you guys remember, we talked about it at the time. He came on the network and talked about it at that time. Obviously, I don't need to tell all of you, stocks have gone virtually straight up since he made that warning. But the points he made in those moments were interesting now to look back at what he was talking about. Asset bubbles, low interest rates, too many ETFs, a bubble, if you will, in passive investing. And now maybe we're witnessing some of that. Was his call precise at that moment? No, he'd be the first one to tell you that. But that's not exactly the point that he was making. It was sort of taking stock in where we were, what's happening in the market, and remembering that maybe this doesn't all end well at some point.
You've been involved in two famous fights with Carl Icahn. Well, not you. Obviously, with Ackman, you've got a book coming out of that in April, I believe.
I do.
And then I remember, and I believe you moderated this, at Delivering Alpha with Larry Fink of BlackRock, which has, of course, probably hundreds of ETFs. And I remember those two guys, didn't they, Scott? They jog our memory, kind of got into it, where Icahn was like, you're creating weapons of mass destruction. And Fink's like, shut up, everything's fine.
Okay, so
I summarized.
You did well, except they didn't kind of get into it. They got into it.
They did.
They fully got into it.
When was that?
That was at Delivering Alpha probably 2.5 years ago.
But there's one thing to have an ETF, and there's another thing to have a leveraged ETF, right?
Sure.
Is the issue the ETFs or the ETNs or whatever, or is it the leverage?
The issue is the leverage.
I mean, 1929
These inverse
was
products,
leverage.
and look, even BlackRock is out today saying that there needs to be more regulation for some of these leveraged products. People don't know exactly how they work. I mean, if you say, okay, it's not just a retail problem, there's very big investors, institutions that got their shirts ripped off and then their faces smacked in the last 24 hours as a result of how this thing traded, both the move, the velocity, and the inability to deal with it.
And here's why people care, and this is a bit wonky again, and I think the description of what happened the last few days is very complicated. We're trying to make it simple. We don't want to dumb it down. An ETF, we obviously know what that is. An ETN, what a lot of people may not realize is it's also backed by the bank that issues it, correct? So if there's a problem with a big ETN, you start to get the sniffs of banks.
Systemic risk.
I'm trying to be real.
Right,
You know,
that's why
how
one
much
of the
money-
banks this morning was
It's
so
not like
quick
we're
to
talking
come out
about,
and say.
what are we talking about in this, the XIV? I mean, how much money was in that? What was it, a couple $billion?
So it was $1.1 billion, but we don't know the exact amount of the leverage included in this. And obviously there was a lot of things that were attached perhaps to the XIV that then spiraled out of control. And for Credit Suisse, who put the ETN out, it's nothing. We get it. But I think at least calls, and I think Carl would agree. I mean, you know him a lot better than I do, which is that these products, if they're that confusing, I'm not sure there's necessarily a need for them.
I don't know that they're confusing.
If there's right,
You're
maybe they
it's
just need to be
double the
regulated.
leverage. It's double.
Right.
I mean,
Then what are they based off of?
The 20-page
What's the levered
prospectus
offer?
is
I would know.
probably
Nothing.
pretty clear on what's involved in these, or you wouldn't have some of the big names and the institutions who are investing in them. It's just you can see what happens when the market psychology changes in the blink of an eye, and people start running for the exits, or they start, things changed on Friday. The jobs report seemed to change things. Wages rose. All of a sudden, you're fearing inflation's run away. So that short of
volatility creeped up just enough.
Volatility is
trigger